This is Market Wisdom for Traders, episode 44, delivered by Twigbe Eizogi. For forex, stock, derivatives, crypto, options, futures, commodities, gold, and all chart-related trading. You can contact us for training, online or physically. You can contact us for account management to manage your funds for you, whether as an individual or as a company. We have been on this business since 2007, so we have close to 2 decades of experience, and we have what it takes to grow your account successfully. So this is part of our contribution to the advancement of your development as a trader. Remember to subscribe, share, and watch our previous videos. Every trader will go through cold spells. When you are trading well, you have a better meta attitude. When you are trading poorly, you start wishing and hoping instead of getting into trades you think will work. You end up getting into trades you hope will work. My money management techniques are extremely conservative. I never risk anything approaching the total amount of money in my account, let alone my total funds. The first rule of trading is for the prospective trader to find the approach that he or she is comfortable with. That is the approach that suits the trader's personality. Virtually every successful trader I know ended up with a trading style suited to his personality. I do not place any direct weight on whether the fundamental news is bullish or bearish. Rather, I focuses on the market's response to fundamental news. For example, if the market is struggling off a barrage of bearish news, I would view that as an evidence of an impending bull move. I decide to actively seek public funds for management because I got tired of seeing my students managing hundreds of millions while I was managing comparatively paltry amounts. I think that the execution edge was probably the primary reason for my success as a floor trader. The major factor that whittles down small customers' accounts is not that the small traders are so inevitably wrong, but simply that they can't beat their own transaction costs. By transaction costs, I mean not only commissions, but also the skill in placing an order. As a P trader, I was on the other side of that skid. I went in with the idea that I could apply the analytical technique that I had picked up as a mathematician to the market in a straightforward manner. I was wrong about that. October 19, 1987, the S&P dropped 8,000 points in one day. This implies that traders need to be more conservative in risk control. Kapopua has championed the idea that all progress in knowledge results from effort to falsify, not to confirm or add theories. You have to try your best to disprove your results. You have to try to kill your little creation. Try to think of everything that could be wrong with your system and everything that is suspicious about it. If you challenge your system by sincerely trying to disprove it, then maybe, just maybe, it is valid. Most things that look good on the chart say 98% don't work. Too fine an eye for pattern, we find it anywhere. In other words, you are going to see more on the chart than is truly there. It is human nature to pick out the stunning successes of a method and to overlook the day in, day out losses that grind you down to the bone. Even the most honest researchers will tend to bias data towards his or her own hypothesis. It can't be helped. This brings us to the end of episode 44 of Market Wisdom for Traders. Remember to subscribe and share. Remember to contact us for account management or training. You can reach us on 080-375-97085. We are currently in Lagos, Nigeria. Thank you.